Selling options is the closest thing that I know to printing money. It's like dividends on steroids. I've been getting a lot of questions in my comments about what I mean when I keep mentioning delta in relations to selling options. So I wanted to take a moment to explain it and give you some clear examples. An options price is made up of several key parameters, and something called the Greeks are 5 of those parameters. And the Greeks are made up of delta, gamma, theta, vega, and rho, with delta being arguably the most important, which is why you're always going to hear options players, whether buyers or sellers, talk about delta. Delta can seem tricky, but it's an absolute game changer when selling options, and I'm here to break it down for you today. This will be a two-part series. Today, we're going to dive in delta for cash secured puts, and in the next video, we're going to cover delta for covered calls. I'll show you examples how delta works using a real hood cash secured put example. So don't go anywhere. You don't want to miss this video. If you're new here, my name is Adam, and I retired in 2024 at the age of 41 years old. My retirement is built on 3 simple pillars, and anybody can do it. Number 1, you got the multi-bagger for growth and asset appreciation. Number 2, you got high yield ETFs and stock dividends for steady cash flow to cover your bills. And number 3, you got the options income strategy to turbocharge your passive income with covered calls and cash secured put premiums in order to buy yourself those nicer things in life. Now, I'm not a financial advisor. This is not advice, just me sharing my real trades with full transparency and no fluff. So if you're tired of these BS YouTubers, never made money outside of YouTubers, making money on your backs, and you want some real content, stick around. We're getting right into it without further delays. Today, we're going to focus on understanding delta for cash secured puts using a $48 strike hood cash secured put expiring in 4-week option. Let's break it down. Let's start with the basics of cash secured puts, or a CSP for short. A cash secured put is when you agree to buy shares of a certain stock at a certain price by a certain date. That certain price is a strike price. That certain date is an expiration date. And you secure this contract with cash, hence the name cash secured put. For example, let's say you're looking at company XYZ trading at $50. You might sell a $45 strike cash secured put expiring in a month from now, 4 weeks, collecting $1 in premium per share or $100 total for a contract. You're saying you'll be buying 100 shares of XYZ company at $45 if the stock drops below that by the expiration date, needing $4,500 in cash to cover it. 100 shares is one options contract. So one contract, 100 shares times $45 gives you that $4,500 cash collateral. Now you guys know everything about options, but what exactly is a delta? Well, delta, for very simple explanation, is how much an options price changes when the stock price moves by $1. It's the relation of your option price to the change of the share price of the stock. It also gives you a rough idea of the probability that the option will expire in the money, or for us as sellers, the chance it expires worthless, meaning we do not get assigned. Now, it's very important for you to understand. For puts in general, the delta is negative, ranging from 0 to -1, because a put's value increases when the stock price falls. But when you sell a cash secured put and you're not the person buying the put, you're taking the opposite side of the buyer's position or the opposite side of the trade. You're short the put. So if a put is betting the price is going to decrease and you're shorting the put, you are betting the price is not going to decrease or go up. So if the put's delta is negative, in general, your position as the seller has a positive delta. Do not get confused. I'm going to get into it with screenshots and details. Just stick around. And if you missed any of the last videos, click on the link up above. It's a playlist with option plays. It's absolutely magnificent. Let me show you what I mean with real examples. Let's use a real example with Robinhood stock, ticker symbol HOOD. By the way, if you don't have Robinhood, what is wrong with you? Follow the screenshots. Hood is trading at $54.53 today, May 9th at the closing. I'm selling a $48 strike cash secured put expiring June 6th, 4 weeks out. Just to clarify, this is just an example. I don't actually hold this specific play. I collected a premium of $1.30 per share or $130 for the contract. Remember, every contract is 100 shares. The delta for the put is negative 0.2083. But since I'm selling the put, my position has a positive delta of 0.2083 because I'm the other side of the trade. Here's why that's important. To make it clear, check out the screenshots right behind me. I've added a comparison showing what happens if I were buying this same put instead of selling it. Look at the screenshot right now. When buying the put, the delta is negative 0.2083. You see it right here in the circle, reflecting the buyer's bearish position. They profit if Hood drops. But as the seller, look at the screen. The screenshot just changed. As you can see, my position flips that delta to positive 0.2083 when I am the seller of the option, showing that I'm bullish on the stock. I profit if Hood stays above $48, and I don't profit if Hood stays below $48. This visual shows you how selling a put puts you on the opposite side of the trade, which is key to understanding your risk versus your reward. As a seller, a positive delta means I am bullish. I want Hood to stay above $48 so that the put expires worthless. And I keep my $130 premium. Please keep in mind, when I say a contract, it's 100 shares. So I'm just multiplying the per share movement by 100. In these examples, it's important to follow the math. And if you're going to play options, you should understand the lingo. That positive 0.2083 delta tells me two main things. Number one, price movement. If Hood goes up by $1 to $55.53, that put value decreases by 0.2083 per share, or about $21 for the contract, because the delta is negative 0.2083 for the put buyer. But since I'm the seller, since you're the seller, my position doesn't lose, it gains $21 in value because I'm closer to keeping my full premium. If Hood drops by $1 to $53.53, the put's value increases by $21. However, my position as the put seller loses $21, as that puts it more likely to be in the money by expiration date. And number two, delta gives you a rough estimate of the probability the option expires in the money for the buyer. A delta of negative 0.2083 means there's about a 20.83% chance Hood will be below $48 at expiration, in the money for the buyer. Not great for me or you as the seller. This means I have about a 79.17% chance of the put expiring worthless. This aligns closely with the 78.15% probability shown here in the screenshot in back of me. It is a great, easy tool to use Robinhood because they automatically give you these numbers without you having to think. This means I have a 78.15% chance of not being assigned. Delta is a great starting point to gauge your odds, though other factors like volatility and other things could tweak that percentage slightly. Delta is the key because it helps you understand your risk versus reward. When I pick a cash secured put where my position has a delta of between a 10 and a 30, I am aiming for a 70 to 90% chance of the option expiring worthless, maximizing my odds and keeping my premium. This helps me tremendously in sniping the strike prices for selling cash secured puts. If I want to be cautious, I'll stick to a strike where my position has a delta of 10 or lower. If I'm conservative, I'll do about a 20-ish. Fun fact, if you're a beginner, stick to about that 20-ish delta. But if I'm confident and I want more risk, I'll go with a 30 delta. The less your delta, the less the risk, the less premium you're going to collect. The higher your delta, the more the risk, the more premium you're going to collect. The simplest way of understanding and use delta is the other side of it is your percentage of winning the trade or the option expiring worthless. If a puts delta is at 20, you've got an 80% chance of winning. If it's at 30, you got a 70% chance of winning. If it's a 40, you got a 60% chance of winning. This is what I find works super easy and well for beginners and intermediate traders. We are not reinventing the wheel here. A 20 delta 4 weeks out will give you approximately 2% on your money with an 80% chance that absolutely nothing happens. You keep your premium and move on to the next play in 4 weeks. This is the best possible explanation I can give you without getting complicated. With this Hood cash secured put, the put has a delta of negative 0.2083. So my position has a delta of 0.2083 because I'm selling this put, giving me roughly that 78% chance of not being assigned. That's pretty good odds for me. If I do get assigned at $48, my net cost is $48 minus $1.30, bringing me down to $46.70 per share, well below the current price of $54.53. So I am comfortable either way. Now, there are other Greeks like gamma that can affect delta. I won't take too much time speaking about it, but let me explain it. As a beginner to intermediate and even advanced traders, I recommend just focusing and understanding at delta first. Gamma measures how much delta changes when the stock price moves by $1. So delta measures how much the price of the option moves for the move of $1 in share price, while gamma measures how much delta moves with relation to a $1 movement up or down for the stock price. For this Hood cash secured put, the gamma is negative 0.0285. If Hood goes up by $1 to $55.53, my delta would decrease by 0.0285 from 0.2083 to 0.1798, making my position less sensitive to further price decreases. This is a secondary factor to know. We'll dive deeper into gamma in future videos, but for now, just get comfortable with delta and how it impacts your trades. I really hope this helped you understand what Delta is. If you have any more questions, please, I'm begging you, ask me in the comments down below. I'm super active. It's my mission to make you understand these things so that you can actually make money like I do. I'm a perfect example. If I can do it, so could you. Do not get discouraged. I highly suggest, if you haven't done it yet, click on this link over here to watch my options playlist and watch every single video where I go over a wide array of different strategies and techniques that I personally use in options selling. I'll see you guys in the next video.